Today we have a very special guest, our mortgage expert, Andrew Nowak from the Choice Mortgage Group. Welcome, Andrew.
Thank you, Ori. It's great to be here.
What are the best loan programs available today for the first-time home buyers?
Well, in general, Fannie Mae and Freddie Mac have great first-time home buying programs that allow you to put down as little as 3%. Depending on your income, there are some other incentives where they may give you some credits towards closing costs. Additionally, the rates tend to be a bit lower for first-time home buyers. So they're trying to help you out with low down payments, give you better interest rates to make it easier for you to get into a property. On FHA, first-time home buyers are pretty much allowed to put 3.5% down. And that's available for any FHA borrower that qualifies for it. And there are some down payment assistance programs that usually go through FHA. The rates tend to be a little bit higher, but those can do some combined financing up to 100%. Beyond that, home buyers have plenty of opportunity to get into properties as first-time buyers.
We mainly cover in single-family homes, townhouses. In condos, it will be a slightly different process.
Condos are always going to have an extra layer of hurdles to jump through. You have to find out all the details about the condo, their reserves, pending assessments, have they done their 40-year certification. So there's additional layers to dealing with condos. But first-time home buyers can buy condos, they can buy single family, they can buy townhouses.
I'm working with a buyer who doesn't have W-2s. He's self-employed. What are the options?
So self-employed, we're going to look at their tax returns. We're going to figure out how much income they make based on what they provide us. Now, a lot of self-employed borrowers tend to write off as much of their income as possible. And even though they're making a lot of money, they're not showing it on their tax returns. So we do have alternative products for them. We have loans where we will look at their bank statements, 12 to 24 months of their bank statements, and do an average of their income. We also have loans where we can look at 1099 only, a profit and loss only. So there's a lot of different products out there that we can do that even though they may write off all their income, there are alternatives to your full doc conventional loan.
So there are options available?
Absolutely. There's an option out there for almost everybody. It's just, are the terms acceptable to the buyer?
How much are they willing to pay each month?
The further you go away from the norm, and I say the norm being a conventional loan or an FHA loan, the further you go away from that, the rates are going to change. And so are the rates and terms acceptable because you've decided to write off all your income or you've done something different with your taxes that take you out of conventional financing?
Do you work with foreign buyers?
Absolutely. We've got some great programs for foreign national buyers. We can do it as a primary residence, a secondary home, and we also have a debt service product for the investment properties. Just to elaborate a little bit on that, a debt service product is where we don't look at the income of the borrower, we look at the income of the property. So if they're buying it as an investment property, we're going to look at how much rent the property is going to generate and does that rent cover the monthly payment. Most of the time we're trying to get to a 1-to-1 ratio where the rent covers the monthly expenses, principal, interest, taxes, insurances, and HOA, if applicable. If it covers that at a 1-to-1 ratio, we're ready to go. There are some other types of products where we can go at 75% debt service coverage. There are some no ratio, but the further we get away from 1-to-1, the higher the rates may be.
You've touched a little bit on investor loans. If somebody wants to get into Airbnb kind of rental income, what are other programs available? What are you looking at? What are lenders, banks looking at?
Okay, so for the most part with investment properties, if you're using it for Airbnb, we can look at short-term rental data to calculate whether or not the property does debt service coverage. For the most part with conventional loans at this time, they're really just using long-term income. So they'll look at the property over a 12-month period. If you have a current lease in place, we'll use that figure. If you don't and you're purchasing, then we'll do in addition to the appraisal, an additional report to determine the market rent. So for conventional, we tend to go off of a lease or the market rent long term. If we're looking at The debt service product, we can go into short-term rental, get that data, and use it to qualify.
If the income is not sufficient, let's say 80% covers 80%, there's 20%, how do you qualify?
Well, again, we have products that go below 1-to-1. We have one that may be at 75% coverage, and again, there's even one that's a no ratio. Again, as you get further away from the 1-to-1, the rates will tend to move up slightly.
And what's your down payment on investment properties?
I think the sweet spot generally is around 20% or more.
Today, Andrew, we are in this gorgeous penthouse that costs $12 million. How do you finance something like this? What kind of loans do you have available?
Well, you really got to start, scrolling through your Rolodex to try and find lenders that will do something on such a high-priced unit. But there are lenders out there that will do up to $10 million in loans. You just really have to find out who your buyer is, what their scenario is. Just because it's a $17 million property doesn't mean that they're not putting down 50% or 75% or they want a small loan. But if they're planning on putting down 20%, it may be a little challenging to find financing.
It wouldn't be your regular conventional, I guess.
No, conventional limits are $806,500. So unless they have a really strong down payment, I think they might have a hard time getting conventional financing.
Got it. Interest-only adjustable rates mortgages, are they a good idea today?
I would say for the right borrower, it may be beneficial. One of the problems I always find with interest-only loans is a lot of times people will get them and they'll say, I'm going to pay down this mortgage really aggressively and lower my balance. But every time you get that monthly statement and you have this low payment because it's only interest only, you're like, all right, next month I'll pay more. And then 10 years rolls by and you haven't made another payment on lowering your balance, and the next thing you know, it fully amortizes and your payment doubles or goes up 2.5 times. So it's dangerous. It takes a disciplined borrower to go with an interest-only loan. A lot of times you find it with some of your jumbo products that someone might want an interest-only loan. And then the ARMs, they don't really have a lot of ARMs available for conventional loans, but more on the jumbo products. Depending on what the borrower's needs, it may work for them. I think it's always better just to get a traditional 15, 20, or 30-year loan. The rates on the 20 and 15 are very competitive right now if you can handle the payment.
Are you saying the interest rates for 20-year and 15-year are lower than 30-year mortgages?
Yeah, generally speaking, the shorter the term, the better the interest rates. So with that adjustable, you have a shorter period that your loan is fixed for. So thus they're going to give you a slightly better rate.
Okay, so is there any benefit working with this kind of product?
It really just depends on what your scenario is. Maybe you're not going to be in the property for a couple of years, or maybe you have a crystal ball and you think interest rates are going to come down and you only need it fixed for 3 years and you think you're going to refi in the next year or two. Or maybe you plan on selling the property in a shorter period of time, so you feel more comfortable having an interest rate locked for a shorter period of time.